So I'm really excited about this video today, but before we dive in, I need to provide a little bit of a disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor, and nothing in this video should be interpreted as investment advice. I may personally be invested in or affiliated with companies I discuss in these videos, and as always, do your own due diligence before making any investment decisions. So with that out of the way, let's dive into today's video. I recently received an email from one of the crowdfunding platforms offering accredited investors the chance to invest in OpenAI at the recent $300 billion valuation. It immediately got me thinking, should I invest? In this video, I'll walk through the bear case, the bull case, and let you know where I came out on it for my own portfolio. First, let's dive into the bear case. There are a lot of reasons that this is a really risky deal. First of all, OpenAI faces intense competition. They aren't alone at the top, and competition is heating up fast. For example, Chinese startup DeepSeek built a GPT-4 level model at a fraction of the cost using smarter training methods, open source releases, and even allegedly distilling outputs from OpenAI itself. Their latest model, DeepSeek V2, trained for just $5.6 million, a massive discount to what it cost OpenAI to build a same or similar model. Meanwhile, you have Anthropic's Claude, Google's Gemini, and a wave of open source challengers that are all closing the gap. This isn't just a battle of who's smartest, it's who can scale fastest, train cheaper, and defend their moat. OpenAI's lead is real, but it is shrinking fast. The next big risk is the legal structure and the lawsuits. OpenAI is facing a wave of copyright lawsuits. The most high profile is from the New York Times, claiming OpenAI and Microsoft used millions of its articles to train ChatGPT without its permission. They're not alone. Alden Global Capital, Mother Jones, The Intercept, and others have filed similar suits. And it's not just news orgs. Authors like George R.R. Martin, who wrote Game of Thrones, Sarah Silverman, the comedian, and Jodi Picoult are also suing, saying their books were used all without consent. All these cases have now been consolidated in a Manhattan court. OpenAI's defense? Fair use, but this legal cloud could hang over them for years. Then you've got Elon Musk, an original co-founder of OpenAI, has filed a lawsuit against the company and CEO Sam Altman, alleging that their shift from nonprofit to for-profit structure betrays OpenAI's original mission to develop AI for the benefit of humanity. Musk contends that this transition prioritizes profit over public good. OpenAI argues, on the other hand, that restructuring is essential to secure necessary funding for AI development. To further complicate things, he and others made an offer to buy OpenAI for over $97 billion.
Consortium led by Elon Musk said on Monday it has offered $97.4 billion to buy the nonprofit that controls OpenAI. It's another attempt by the billionaire to block the artificial intelligence startup from transitioning to a for-profit firm.
All of these legal risks, at minimum, are a huge distraction and very costly, and in a worst-case scenario, could actually put OpenAI out of business and be very detrimental to the company overall. Let's dive into burn rate and losses next. So OpenAI is burning through cash at an astounding rate. In 2024, the company spent approximately $9 billion while generating $3.7 billion in revenue, resulting in a $5 billion loss. The costs are driven by $3 billion in training AI models, $2 billion for running them, and over $700 million in salaries. Even with 15.5 million paying subscribers, OpenAI loses money on each and every user. That's not going to scale super well, right? Projections for 2025 estimate an $11.6 to $12.7 billion in revenue, but if spending continues at the current pace, losses could exceed $14 billion. This raises critical questions about the sustainability of OpenAI's business model, and if they can't start getting benefits and efficiency from scale, this may not be a business model that can work in the long run. The next thing you have to think about is valuation concerns. So a $300 billion valuation is staggering. That's a 68 times their annual recurring revenue, which is extremely high. For some context, some of the most expensive tech companies trade in the 10 to 20x range. All this on a business that, as I mentioned earlier, is spending $2 for every $1 in revenue they bring in. They have a long way to go to generate the profits that will be necessary to support even this current valuation, let alone a valuation that enables investors to generate a return. It also means that this has to someday be worth even more to generate a good return on my investment. It has to become one of the top 10 most valuable companies ever, which that's really hard to do. In summary, you have a company that might be overvalued, and over time, competitors will catch up, eroding their ability to charge a premium for their services, which they have to charge in order to keep up with the high compute costs. When that happens, the valuation could plummet. There you go. That's kind of the bear case on why I probably shouldn't make an investment in OpenAI. Okay, but here's the other side of it. There's 40 billion reasons why the bull case might be right. Assuming OpenAI converts to a for-profit company by the end of the year, of course, and unlocks the additional $30 billion that SoftBank has promised it. So here are a few more reasons. First of all, ChatGPT is the verb, right? I am a big fan of ChatGPT, but even I am surprised at how many people have replaced their search engines, like Google, with ChatGPT. People might occasionally talk about other MLSs and AI tools, but everyone refers to the most is ChatGPT. They spend almost nothing on marketing because everyone talks about it, promotes it, sells courses on it, builds apps on it, and compares it, etc. The most a competitor can possibly hope for is to be compared to OpenAI and ChatGPT. It is the brand when it comes to AI. And if you watch my other videos on AI, you know that I believe that awareness and marketing of products will be one of, if not the critical factor in determining who wins in the world where AI can help you build and launch almost anything almost for free. The next thing is, because of this brand, they have massive adoption. The adoption and the growth of adoption of OpenAI's products is simply unprecedented. Here are some quick stats. So today they have 800 monthly active users, 400 weekly active users, and 123 million daily active users. Just for context, these rates are crazy. In just the month of March, they recorded 4.5 billion website visits and over 1 billion queries every single day. Here's the even crazier thing. Weekly active users doubled from February to March from 400 million to 800 million. That means 1 in every 10 people in the world used ChatGPT last month. That is just crazy for an app that has only been available for 2.5 years. Just for context, it took Instagram 75 days to get to 1 million users, which was insanely fast and held the record for a long time. OpenAI did that in just 5 days. Facebook took 8 years to get to 800 million monthly active users, and OpenAI did it in 2.5 years. In fact, it took Facebook 2 years to go from 400 million monthly active users to 800 million monthly active users, something OpenAI did in just 1 month. No matter how you cut it, the growth of this product is unprecedented and far beyond any of the competition. All right, let's jump into what that means for revenue. Not only is there insane user growth, but this has also resulted in crazy revenue growth. They achieved $1 billion revenue run rate in under 1 year, the fastest of any company ever. And revenue growth just keeps going, as you can see in this chart. This year, they say they are on track to do $11.6 to $12.5 billion in revenue, but they've always underestimated revenue, so we'll see where it actually comes out. It could be even higher. All right, let's talk about their ability to build an actual moat and keep all of these smaller companies that are chasing at their heels at bay. One of OpenAI's biggest power moves is the Stargate initiative, a $500 billion AI infrastructure project backed by Oracle and SoftBank. It's not just about building data centers, it's about controlling the compute layer of AI and its future. If OpenAI owns the pipeline from model to silicon to server, it massively reduces costs, scales faster, and builds a moat competitors can't match. This could be their AWS moment. My belief is that this is where OpenAI has a real opportunity. Just as there's nothing inherently special about AWS, I mean, it's just a bunch of hard drives and processors connected to the internet after all. What is special is the entire ecosystem and ease of use to operate in the cloud with AWS. This is the opportunity for OpenAI. Become the AWS of AI. You've already seen the power of this with DeepSeek. It may be a powerful tool, but it almost immediately collapsed from demand, is hacked, and continues to lack the tools to make it really enterprise grade. OpenAI has all of that in place today. Add to that their models are consistently the best with each new iteration, and you have a very compelling reason for large companies to build on their platform and never leave. The next is distribution. Now, distribution is the last big moat, and I believe that it will likely matter most of all. Part of this is awareness and brand, which we already talked about, but part of it is also how easy it is for people to access it. Meta, X, and Alphabet's products all have huge advantages here because we use those products all the time, and so it's easy for them to push their AI products to us. OpenAI, however, has its hooks in Microsoft, Apple, and Samsung, companies that will likely never give that distribution access to their big competitors, Meta and Alphabet. This gives OpenAI the distribution that they need in order to compete with some of those other bigger companies. In the bear case, I talked a lot about valuations, and $300 billion for a company is a lot of money, no matter how you cut it. That said, all of this really boils down to the valuation. Can I justify paying $300 billion for this company by underwriting a return that rewards me for taking the risk? So, as I mentioned before, paying 68 times revenue is very expensive. But if they get to $12.7 billion in revenue this year, that's only 24 times revenue, which is expensive, but in the range of a lot of other high-flying tech companies. If we look at annual recurring revenue multiples, those get even better given the fast growth of this business. At an estimated $16 billion of ARR by the end of this year, that would even lower the multiple to an 18x. For context, that's right in the range of companies like CrowdStrike, ServiceNow, and Datadog, which are all growing in the 25% range. So, while still high, it's not as unrealistic looking into the future. So, what is the potential of OpenAI during a 5 to 7 year hold period? I use 5 to 7 because it is unlikely the company will achieve a high return in less time, and any longer becomes challenging because that is a long time to lock up my capital. So, what do potential returns look like? Each of these exit values has a different likelihood of occurring, likely and diminishing likelihood as the number gets bigger. There is also the likelihood that you just get your money back or lose money. But for now, I just want to assess what the upside potential is and how I feel about the potential of that occurring. This is the hardest part of valuation, the art versus the science, and the thing that differentiates okay and great investors. In this case, I'm going to look at Meta as a comparable company. Here's Meta's revenue and valuation growth over time. If we look at Meta's revenue growth, and valuation over time, and compare it to OpenAI, there are a few things that stand out. First of all, OpenAI is growing way faster than Meta ever did, but even if we use Meta revenue multiples over time, OpenAI does have a credible case of making it to $1 trillion valuation by 2029, which is about 5 years out. We can even slow down revenue to grow closer to Meta's growth rate, and they still have a potential of achieving a $1 trillion valuation in 7 years. This gives me some confidence that $1 trillion is actually possible during my hold period, but going above that might be tough. OpenAI is growing faster, but is far less profitable during this time period than Meta was and is today. So it's not an entirely fair comparison. But then again, nothing can be at these sizes. So the punchline is that for me, I feel like there is a good case to be made that $1 trillion valuation is feasible during the next 5 to 7 years, assuming growth rates continue. That would result in a roughly 3x return on my investment if I were to invest at this current valuation, and an internal rate of return between 17 to 25%. What that basically means is that my investment would be growing by 17 to 25% every year that it's invested in the company. So, should I invest in OpenAI at this $300 billion valuation? Well, in full disclosure, I've personally been an investor in OpenAI for years, and just recently invested through University Growth Fund in the round raised in October. That round was priced at about $157 billion, and the thought at the time was that the upside case is that OpenAI is on track to become one of the biggest tech companies of all time, in the sphere of Meta, Alphabet, Microsoft, Apple, Amazon, and Nvidia, all of which trade at north of $1 trillion in value. At that valuation, you're looking at about a 5 to 7x cash return and a 26 to 48% IRR over the next 5 to 7 years. To me, that felt like a good risk-return profile, given the significant risk and likelihood of achieving that outcome. At $300 billion, those returns drop to 2 to 3x with dilution and 17 to 25% IRR. And at that range, the risk-return profile feels a lot tougher, at least for me personally. Now, clearly, $10 to $40 billion of smart money disagrees with me, But this actually illustrates another interesting point. As an investor, you have to figure out how much of a return you need to justify the risk. And we all have different risk tolerances and costs of capital. You have to figure out what is right for you based on, how risk tolerant you are and what your personal cost of capital is. In this case, SoftBank and others likely have a very different risk profile, cost of capital, and hold period than I do. Anyways, as I mentioned at the beginning, this isn't advice, it's just my thought process. Hopefully it was educational and entertaining. If you want more analyses like this, don't forget to subscribe. I'd love to hear what you think about investing in OpenAI. Have I made a massive mistake or the trade of a lifetime? What would you do? Let me know down in the comments. Thanks.